You know what's weird about trading? Most people think that making 10 profitable trades in a row means you've finally figured it out. But here's the reality that nobody talks about. Those 10 wins are exactly when your brain starts playing tricks on you. Professional traders call this the confidence trap, and it's responsible for wiping out more accounts than bad strategies ever could. The moment you hit that 10th consecutive win, something shifts in your psychology that makes the next trade more dangerous than your very first one. This isn't motivational nonsense. This is documented, researched, and backed by actual data from trading psychology studies. So if you've been on a winning streak or you're chasing one right now, what I'm about to share could save you from the brutal reality that catches nearly every trader off guard. Let me take you inside what actually happens in your brain when you start stacking wins. When you make your first profitable trade, your brain releases a small amount of dopamine. It feels good, but it's manageable. By the third or fourth win, your confidence grows, and that's natural. But here's where it gets interesting. By the time you reach your 7th, 8th, and 9th consecutive profitable trade, your brain chemistry has fundamentally changed. Dopamine receptors in your nucleus accumbens become increasingly activated, and your prefrontal cortex, the part responsible for rational decision-making, starts to take a back seat. This isn't me making stuff up. Neuroscientist Dr. Brian Knutson at Stanford University conducted research showing that anticipation of monetary rewards activates the same neural pathways as addictive substances. Your brain literally begins treating trading wins like a drug. Now here's what makes this dangerous. After 10 consistent wins, most traders experience what psychologists call the invincibility bias. You start believing that you've developed an edge, that you've finally cracked the code. Your risk management rules, the ones you followed religiously during your first few trades, suddenly feel unnecessarily conservative. You think to yourself, why am I risking only 1% of my account when I've been right 10 times in a row? This is where the trap snaps shut. Research from the University of Cambridge found that traders experiencing winning streaks showed increased levels of cortisol and testosterone, hormones that increase risk-taking behavior and decrease fear responses. Your body is literally biochemically pushing you toward bigger, riskier trades. Let me tell you about something called the gambler's fallacy, but in reverse. Most people know that thinking a roulette wheel is due for red after 10 blacks is irrational, but winning traders fall into the opposite trap. They believe their winning streak proves they have skill, when in reality, even a completely random strategy can produce 10 consecutive wins. The mathematics here are sobering. If you have a trading strategy with a true 50% win rate, the probability of getting 10 wins in a row is roughly 1 in 1,000. Sounds impossible, right? Except when you consider that millions of people are trading every single day. Thousands of traders will experience this purely by chance. The human brain isn't wired to understand this. We're pattern recognition machines, and we desperately want to believe that our wins are skill-based, not luck-based. Here's where trading changes fundamentally after those 10 trades. Your perception of risk becomes distorted. Studies from Duke University's Center for Advanced Hindsight found that traders who experienced winning streaks estimated their probability of future success at rates 30 to 40% higher than traders who had mixed results, even when using identical strategies. Think about what this means practically. If you've been risking 2% per trade and you're now subconsciously estimating your win probability at 80% instead of the realistic 55%, you might start risking 5% or even 10% per trade. The math becomes devastating. 1 or 2 losses at that increased risk level can erase weeks of careful gains. Professional trading firms have known about this phenomenon for decades, and they've implemented systematic safeguards. Many proprietary trading firms enforce mandatory breaks after a certain number of consecutive wins. Some reduce position sizes after winning streaks, which seems counterintuitive until you understand the psychology. They've learned through painful experience that protecting traders from themselves during winning streaks is just as important as supporting them during losing streaks. The retail trader working from home doesn't have these institutional protections. You're your own risk manager, your own psychologist, and your own worst enemy. Let's talk about what happens to your trading process after 10 wins. In the beginning, when you were newer to trading, you probably spent time analyzing charts, checking multiple time frames, confirming your setups with indicators or price action patterns. You were methodical because you were afraid of losing. Fear, in controlled amounts, is protective. But after 10 consecutive wins, something insidious happens. You start taking shortcuts. You see a setup that's 70% similar to your winning trades, and instead of waiting for full confirmation, you jump in early. You start trading based on intuition rather than rules. This feels like evolution, like you're becoming an instinctive trader who can feel the market. In reality, you're abandoning the very process that produced those wins. There's a concept in trading psychology called process versus outcome orientation. Professionals focus on process. They know that if they follow their rules perfectly, they'll be profitable over time. But any individual trade can still lose. Amateur traders become outcome-oriented, especially after winning streaks. They start judging their trading decisions based on whether that specific trade made money rather than whether they followed their process correctly. This is catastrophic because it creates a feedback loop. A sloppy trade that happens to win reinforces sloppy behavior. You start believing that your intuition is better than your rules, and the market, being the efficient beast it is, will eventually punish that deviation. Here's a specific example of how this plays out in real trading. Imagine you've been trading a simple breakout strategy. Your rules say wait for a daily close above resistance, then enter on the retest. For 10 trades, you followed this exactly, and all 10 worked. On trade 11, you see price pushing against resistance during the middle of the day. Your old self would wait for the close, but after 10 wins, you think you understand what's about to happen. You enter early to get a better price. Maybe this trade works, maybe it doesn't, but the damage is done. You've now established that your rules are suggestions rather than requirements. Within a few weeks, you're entering trades based on partial setups, incomplete patterns, and gut feelings. Your win rate drops. But because it happens gradually, you don't connect it to the process breakdown that started after your winning streak. The financial impact of this psychological shift is measurable. A study published in the Journal of Finance tracked thousands of retail traders over multiple years. They found that traders who experienced significant winning streaks subsequently underperformed the market by an average of 6 to 8% over the following months. These weren't bad traders. These were people who had demonstrated the ability to make profitable trades, but the psychological aftermath of their success undermined their future performance. The research showed that the larger the winning streak, the more severe the subsequent underperformance. It's almost as if winning too much, too fast, programs you for future failure. Now let's address what experienced traders do differently. Professional traders treat every trade as independent. They understand probability. They know that having 10 wins doesn't increase the likelihood of the 11th trade being profitable. This sounds obvious when you read it, but it's incredibly difficult to internalize when you're in the moment with real money on the line and a dopamine-soaked brain telling you you're invincible. Professionals also use what's called equity curve analysis. They track not just their win rate, but the consistency and sustainability of their returns. If they notice their equity curve becoming too steep, meaning they're making money faster than their historical average, they become suspicious rather than celebratory. They ask themselves what's changed. Are they taking bigger risks? Are they deviating from their process? This kind of self-awareness is rare. Another thing that changes after 10 consistent trades is your relationship with loss. In your early trades, losses were educational. They hurt, but you expected them because you were learning. After a 10-trade winning streak, your first loss feels completely different. It feels like a failure, like proof that your streak is over, like maybe you never had it figured out after all. This emotional intensity causes traders to make reactive decisions. Some immediately jump into revenge trading, trying to win back what they lost and restore their streak. Others become paralyzed, afraid that any trade they take will be another loss. Both responses are emotionally driven rather than strategically sound. The loss itself might be completely normal, well within the statistical parameters of their strategy, but the emotional response to it is magnified by what came before. There's also a social dimension that most traders don't consider. If you've been sharing your wins on social media or with friends, you've created external pressure. After 10 wins, people start seeing you as a successful trader. You might have people asking you for advice, wanting to know your secrets. This external validation feeds your ego, but it also creates a fear of public failure. You don't want to be the person who was winning and then suddenly wasn't. This social pressure, even if it's self-imposed, affects your trading decisions. You might hold losing trades longer than you should because you don't want to admit the loss. You might take trades you wouldn't normally take because you feel pressure to maintain your image as a winning trader. Let's get specific about what changes mechanically in trading after consistent success. Your entry criteria often become looser. A setup that you would have skipped in trade trade 3 or 4 suddenly looks good enough in trade 12 or 13. Your stop losses might move further away because you're more confident the trade will work. Your profit targets might become more ambitious because you've been hitting them consistently. All of these micro adjustments feel like optimization, but they're actually introducing more randomness and risk into your trading. You're deviating from the sample size that proved your strategy works. In statistical terms, you're changing variables without establishing a new baseline, which means you can no longer be confident in your edge. Here's something that almost nobody talks about. Winning streaks often coincide with favorable market conditions that are temporary. Maybe the market has been trending strongly and your trend-following strategy has caught every move. Maybe volatility has been high, giving your breakout strategy perfect conditions. The 10 trades that worked aren't just about your skill. They're about the alignment between your strategy and current market conditions. But markets change. Trends become ranges. Volatility contracts. When the market regime shifts, your strategy will naturally perform differently. The trader who understands this relationship remains humble and adaptable. The trader who attributes all success to personal skill gets blindsided when conditions change. Risk of ruin is a concept every trader should understand, but most ignore until it's too late. It's the mathematical probability of losing your entire trading account. When you're following strict risk management, risking only 1% per trade with a strategy that has a positive expectancy, your risk of ruin is extremely low. But after 10 wins, when you start increasing your risk per trade, your risk of ruin increases exponentially, not linearly. Going from 1% risk to 3% risk doesn't triple your risk of ruin. Depending on your win rate and reward to risk ratio, it might increase your risk of ruin by 10 times or more. This mathematical reality doesn't care about your confidence or your winning streak. Let me share what the actual data shows about trader longevity. The majority of retail traders lose money. We know this. But when you break down the data further, you find that many of these losing traders had periods of profitability. They didn't fail because they couldn't make winning trades. They failed because they couldn't manage the psychological and behavioral changes that came with success. There's a study from the French Financial Markets Authority that tracked 40,000 new traders. They found that traders who made money in their first few months were actually more likely to eventually lose their entire account compared to traders who lost money initially. The early winners became overconfident and increased their risk, while the early losers remained cautious and focused on learning. The concept of mean reversion applies not just to markets, but to trading performance. If your results are significantly better than your long-term average, they're likely to revert toward that average. This isn't pessimism, it's statistics. If your typical win rate is 55% and you just had 10 wins in a row, representing a 100% win rate over that sample, the next 10, 20, or 30 trades will likely bring your overall win rate back down toward 55%. This means you should expect more losses coming, not fewer. But the psychological trap is that your brain expects the opposite. You expect the winning to continue. When reality doesn't match expectation, the emotional whiplash is severe. Here's what you should actually do after 10 consistent trades. First, audit your process. Go back through each trade and honestly assess whether you followed your rules exactly. If you find that you've been getting sloppy, tighten up immediately. Second, review your risk management. If you've been increasing position sizes or risking more per trade, bring it back down to your original parameters. Third, take a break. This sounds counterintuitive when things are going well, but stepping away from the screen for a few days can reset your psychological state. You'll come back with less emotional charge around your trading. Fourth, update your trading journal with detailed notes about how you're feeling. Write down your confidence level, any urges to take bigger risks, any thoughts that your rules don't apply to you anymore. This self-awareness creates a buffer between impulse and action. Professional trading is boring. It's the same setups, the same rules, the same risk management, executed consistently over thousands of trades. The excitement comes from the results, not from the process. When trading becomes exciting because you're on a winning streak and you're taking bigger risks and you're feeling invincible, that's when you're in danger. The most successful traders I've studied describe their best trading periods not as thrilling, but as routine. They were simply executing their plan without emotional interference. The moment trading feels like you're on top of the world is the moment you need to become more conservative, not less. There's a brutal honesty required in trading that most people aren't willing to face. You have to be willing to admit that you don't know what's going to happen next. You have to be willing to admit that your last 10 wins don't guarantee anything about your next trade. You have to be willing to admit that the market doesn't care about your confidence or your feelings or your winning streak. This level of intellectual humility is uncomfortable, especially after you've you've been proven right repeatedly. But it's the only mindset that allows for long-term survival in trading. Every professional trader has stories about blowing up accounts or going through devastating losing streaks, and almost universally, these disasters followed periods of significant success. The pattern is so consistent, it should be taught as a core part of trading education, right alongside technical analysis and risk management. So why does trading change after 10 consistent trades? Because you change. Your brain chemistry changes, your confidence changes, your risk perception changes, your adherence to process changes, and your emotional relationship with the market changes. The trades themselves haven't changed. The market hasn't fundamentally shifted. You have. And if you don't recognize this transformation and actively manage it, those 10 wins become the setup for significant losses. The traders who make it long-term are the ones who remain skeptical of their own success, who treat winning streaks as statistical variance rather than proof of mastery, and who understand that the real skill in trading isn't making money when things go right. It's protecting that money by not doing stupid things when your ego tells you you're invincible. That's the real edge, and it has nothing to do with indicators or patterns or market analysis. It's pure self-management, and it's why trading is ultimately more about psychology than anything else.